Quick heads up, this video is for educational purposes only and is not professional financial advice. Do your own research before investing. Alphabet, ticker Google, $4.28 trillion in market cap. The stock just jumped 4.82% in a single session, and it's sitting at $353.65 right now. But here's the number that stops you cold. Our discounted cash flow model puts fair value at $133.97 per share. So is Wall Street pricing in a future Alphabet hasn't earned yet? Or is the model simply missing something massive? Alphabet isn't just a company. It's the infrastructure of the modern internet. Built in 1998, headquartered in Mountain View, California, and employing over 185,000 people worldwide, Alphabet touches nearly every corner of the digital economy. Google Search alone commands a dominant share of the global search market. YouTube is the world's second-largest search engine. Android powers the majority of smartphones on the planet. Chrome is the dominant browser. And then there's Google Cloud, one of the fastest-growing enterprise platforms in the world, competing directly with Amazon Web Services and Microsoft Azure. The business runs across three segments. Google Services handles advertising, hardware like Pixel phones and Nest devices, the Google Play Store, and YouTube. Google Cloud sells infrastructure and collaboration tools to enterprises through Google Workspace. And the other bet segment bets on the future, health technology, internet services, and moonshot projects. Revenue just crossed $400 billion. Net income hit $132 billion in the most recent fiscal year. This is a machine. But the question is whether the stock price already reflects perfection, and then some. Over the past 254 trading days, Google has been anything but boring. The stock carved out a 52-week low of $172.77, nearly half of where it trades today. From that trough, it staged a powerful rally, pushing all the way to a 52-week high of $408.61 before pulling back. The current price of $353.65 sits closer to that high than the low, roughly 14% below the peak. The moving average setup tells a constructive story. The 50-day moving average has crossed above the 200-day moving average, a golden cross formation, signaling sustained bullish momentum from a technical standpoint. That crossover typically attracts trend-following institutional money. RSI momentum currently sits in elevated territory, suggesting the stock is neither deeply oversold nor dangerously overbought in the short term, but is leaning toward the stronger side of neutral. The recent 4.82% single-day surge adds urgency. Momentum is with the bulls right now, but price extended above fair value is a risk of its own. Start with the revenue line. In 2021, Alphabet generated $257.640 billion. By 2025, that number reached $402.960 billion. That's growth of 56.4% over 4 years, steady, compounding, and remarkably consistent for a company this size. But the real test of a business isn't revenue. It's what falls to the bottom line. Gross margin sits at 59.7%. Operating margin is 32.1%. Net margin hits 32.8%. For every dollar Alphabet earns, nearly 33 cents become profit. That's elite-tier efficiency. Earnings per share tell the same story. EPS went from $5.69 in 2021, dipped to $4.59 in 2022, during the ad market downturn, then rebounded sharply, reaching $10.91 in 2025. That recovery and acceleration is exactly what quality compounders do. Free cash flow is healthy but worth watching. It climbed from $67 billion in 2021 to $73 billion $270 million in 2025. Solid, though the growth rate lags net income, suggesting rising capital expenditures, particularly in AI infrastructure. The balance sheet is a fortress. Debt to equity of 0.14 times. Current ratio of 2.01 times. Return on equity of 31.8%. There are no red flags here, just a business operating near peak efficiency. Based on our discounted cash flow model using a 10% discount rate and a terminal growth rate of 2.5%, our fair value estimate is $133.97 per share. The stock is currently trading at $353.65. That's a negative margin of safety of 62.1%. In plain terms, the stock would need to fall by more than half just to reach intrinsic value on this model. The multiples confirm the premium. Alphabet trades at 28.7 times earnings, above its own 5-year average of 24.1 times. Price to sales comes in at 9.4 times. EV to EBITDA at 21.2 times, and price to free cash flow at 51.8 times, a number that reflects just how richly the market is pricing future AI-driven growth. Now, the scenario breakdown. In the bearer case, slower growth, margin compression, fair value drops to $113.88. In the base case, intrinsic value is $133.97. Even in the bull case, where AI monetization accelerates and margins expand further, fair value reaches only $154.07. All three scenarios sit dramatically below today's price. The market is pricing in a future that has to go almost perfectly right. 4 risks stand out for Alphabet shareholders. First, regulatory pressure. Alphabet faces active antitrust proceedings in the United States and Europe, targeting its search monopoly and advertising technology stack. A forced breakup or behavioral remedy could permanently impair its highest margin revenue streams. Second, AI disruption to search. Generative AI competitors like ChatGPT and Microsoft's Copilot are chipping away at traditional search behavior. If query volume migrates, Alphabet's core advertising engine takes a direct hit. Third, valuation risk. Trading at 62.1% above DCF Fair Value leaves virtually no room for execution disappointment. Any guidance cut or margin miss could trigger a sharp derating. Fourth, capital expenditure inflation. Alphabet is pouring tens of billions into AI infrastructure annually, and if returns on that spending disappoint, free cash flow growth stalls at a moment when the market is pricing in acceleration. On the catalyst side, Google Cloud is the most powerful near-term driver. It's growing faster than the core business. And every point of market share gained against AWS and Azure flows directly to operating income. YouTube subscription and connected TV revenue streams are under-monetized relative to their audience scale. Alphabet's own AI models, Gemini in particular, could unlock new monetization layers across search, workspace, and cloud simultaneously. And with a fortress balance sheet, a major buyback acceleration or surprise capital return announcement could re-rate the stock quickly. The verdict is buy, but with clear eyes. 86% of 83 analysts agree, and the fundamental case is hard to argue with. Revenue crossing $400 billion, net income at $132 billion, margins near 33%, and a balance sheet carrying almost no debt. The bull case is simple. Gemini, Cloud, and YouTube compound for another decade and justify every dollar of premium. The bear case is equally simple. At 62.1% above fair value, you are paying for perfection in a business facing real regulatory and competitive headwinds. One stumble and the repricing is brutal. The base case fair value stands at $133.97. Alphabet is a world-class business trading at a world-class premium. Know what you're buying and know the price you're paying for it. If you found this breakdown useful,